This is the Millennial Realtor Podcast. Thank you for joining us today. Today I'll have Dave Marzinke from the Marzinke Lending Team to talk about those scary fixer-uppers. And that's a very good topic, especially when you're kind of going out there and there's inventory out there, that there's a house that's got some work on it. Might be a roof, might be, a bathroom or bedroom that needs to be updated, or kitchen needs to be updated. So with Dave today, I'm going to be talking about the process of getting a rehab loan to make that scary house into a nice, pretty house that you're going to bring your family for Christmas, Thanksgiving, and show off the nice, cool upgrades. Okay, so here with Dave Marzinke from the Marzinke Lending Team. Thanks for joining.
Yeah, thanks for having me, Conrad. This is exciting to be on with you, and congratulations on your success with the podcast.
Oh, thank you. Yeah, you're right. The Player FM names us as top realtor podcast in the country. So that was kind of cool that I looked it up yesterday and it said, Connecticut, and then me, right there in the middle of the country. So I appreciate that.
Yeah.
So thanks for joining the podcast, and your expertise is very, very helpful on the topic of scary homes to make into a nice and pretty about it. So, but before we go into that, tell us about yourself and how you got into the lending business.
Yeah, so I've been in the mortgage industry since 2003, December of 2003, and went through the whole financial crisis in 2008, survived that. But I got into the business because some buddies of mine started their own company. Back then. We were basically helping people out with refinances and purchase loans back in the day. And then, decided to go out and start generating my own business and generating my own book of business. So I joined Movement Mortgage here in 2013. And been with them for 6.5, almost 7 years now, and thrilled to be with the company, and thrilled to be in a relationship with you and your parents for a long time, and done a lot of business together. So.
Good. Yeah, it's a good partnership that I think we've developed over the time, and it's great as far as what you've done. And starting in 2003 is kind of an icky time period between 2003 to 2009. I think that was a lot of learning for everybody.
Yeah, we definitely learned what to do and what not to do.
Yeah, absolutely. Yeah. So the scary topic of fixer-uppers. So, working with millennials like myself, a lot of times we see HGTV, we see all these pretty reality TV shows, and then, they come into this house that needs some work.
Right.
So you have a great solution on that. What is that exactly?
This is just a great product. There's 3 different types of renovation, or 3 different categories, and there's some subcategories in it. But everybody, when they find the perfect location, but maybe the house doesn't fit their style or the aesthetic doesn't fit their style. Location's obviously the most important part of real estate, because that's what you always hear, right? Location.
Absolutely.
Location. And how many times have you been out with buyers and they say, "Well, I love this house, I love the location, but only if it had this, or only if it had that." Well, the renovation loans allow you to take that house and then turn it into the house that you really want, and do that by financing the cost of the renovation into the mortgage, the purchase mortgage, or the refinance, but mainly the purchase mortgage, so that you can have that dream house and have those finishes the way you want them, have the kitchen the way you want it, have the bathrooms the way you want it. So that's what they do, and we can go through the different categories and all that as we go into this.
Sure, absolutely. Obviously I'll ask different questions on that. So getting into that, I guess one question that I heard from a lot of first-time home buyers that are, I kind of hooked them into the idea of renovating the house and then moving in there. One question is, am I going to be upside down in the house?
No, definitely not. And the reason why is, you still have to put money down as a down payment. And so the way this is structured is they take the purchase price of the home, and then we have a contractor that comes out and will do the budget or the bid based on the things that you want done as the buyer. And then when we go through the process, we order the appraisal, and the appraiser gives the property value based on those renovations being complete.
Okay.
What we call our future value. And so the loan is based off of that future value. So if you buy a home, for example, of $500,000, but the comparable properties that are fixed up and actually in top condition are selling for $600,000, the loan's going to be based off that $600,000 figure, and you're not going to be upside down because your property is going to be worth what the market shows it's worth.
Sure.
Based after those renovations are complete and after the finishes are done.
So in essence, you can definitely steal a property from everybody else, from
Exactly.
all those flippers, all these investors that kind of get out there and hammer down the price all the way down to well below market, and then they fix it up and they put it maybe a little bit above that after rehab value.
Exactly. And sellers like these programs because they're not dealing with just cash-only buyers that are trying to, like you said, just drive that cost down and get it, well below what they can get it for. And, the buyers like this program because it opens up options for them. So they maybe find the home in the school district that they wanted in, or find it in the location close to their work, and then they can have the home turned into that dream home or what they really want it to be.
Yeah, so I think that's such a great thing as far as the market. You have a solution not only for the buyers to find, but also protecting the sellers. I think that's really clear that it works out for everybody's best interest. So, and I think that's kind of real key that nobody really thinks about is the seller. Oh yeah, okay, so it's going to protect the seller from those investors. So, okay, what are the general renovation type of loans?
Yeah, so we have basically three categories. So we have the renovation loans that are within FHA guidelines, Federal Housing Administration. We have the programs that are within the conventional Fannie Mae guidelines, which is called Home Style. And then we have our VA renovation program. So you can actually do a renovation loan as a VA buyer, Veterans Administration.
That's good. Good. So you have the veterans that, how's that program work exactly? I haven't really asked you because I haven't run into a veteran that's looking for a fixer. Is it the same process with a VA loan that's zero down and then renovation, or how does that?
Yeah, so basically they're allowed up to $50,000 in renovation costs on that, and it goes through the same process. We have to have a contractor, we have to have an inspector come out and inspect the work, and it has to be done by a licensed general contractor. It's not where we're just giving away money and the veteran or the buyer can come in with their buddies and renovate the home. It's done with an actual contractor.
Okay. And then FHA, there's and conventional, there are limits as far as purchase price.
Yeah.
Well, obviously, based according to the market. I know I have listeners that are outside Orange County and outside of LA, might be in Inland Empire, Northern California, and San Diego, and maybe Riverside. But
So there's pockets everywhere, even in the high-cost counties like LA and San Diego and the coastal areas. There's still pockets where these products can be used. But the loan amount is limited to what the county loan limit is.
Okay.
So for Orange County, LA County, that's $726,350. And then if you go into the Inland Empire and those things,
be less.
Whatever the FHA county limit is and whatever the conventional county limit is.
Gotcha. Okay, so the limit on the actual loans are going to be the same, and then plus that second mortgage for the costs.
Yeah, and it's not a second mortgage; it's all one mortgage.
Okay.
So the way that works is, we calculate the first mortgage based off the future value, and so then the money's released at closing. So you have the money to take care of the seller and get their proceeds to the seller, and then you have the leftover money for the construction, the renovations held in escrow. Held within an escrow account.
Okay.
And then those are distributed based on the work that's being done. So, but it's all just one mortgage on the property. It's not two loans. Gotcha.
Okay. So based on the mortgage is concerned, they have to qualify for the larger amount, I'm assuming.
Yeah. So we underwrite this. So the way we do the consultation is to say, we have a property in mind that we've identified, right, as a buyer. And so then we'll sit down and we'll say, okay, based on expertise and advice from the agent like yourself, say, okay, what's the future value of this property if we have these renovations done? Basically, what's the market comping out at above the sales price of what we could get the price for on this property? And then we do the pre-approval based on that future value.
Okay.
And so we'll do, like if we're using FHA's products, the minimum down payment is 3.5%. And so we'll do the future value, say it comps out at $600,000, we'll do 3.5% down payment on that, and then they're qualifying off of that larger loan amount.
Okay, that's good. Now the process to rehab the house, what's the limitation as far as, because the other question that I get all the time is, well, I don't want this house to be going under, too long to be renovated. How long does it have to be? What's the limitation generally?
Usually the work has to be done within 6 months. That's the timeline. And the great thing about the FHA product is that you can actually build in 6 loan payments into the budget, the renovation budget. So if you are having to live in an apartment while the work's being done, if you're doing a major renovation on the house, the first 6 months of the loan are already paid for because it's built into the renovation budget.
Nice.
So you're not making 2 mortgage payments, you're not making 2 housing payments.
Right. Right. So if you're either renting or living in a house to move up, you can still have time for that to process, and at least that's taken care of. That's one less headache to deal with in the meantime. So all your HOAs, taxes, all that's taken care of before you move in. That's awesome. Okay. Now, as far as with the renovation process is concerned, the contractors that are doing the repairs, what is their qualifications? What are they? How? Is it anybody that can rebuild the house, or is it specific guidelines?
Yeah, so there's specific guidelines to which contractors we can use. They have to be a licensed general contractor. It can't be a subcontractor or anything like that. And then they have to be an approved contractor. If we're going FHA, we have to have an approved contractor that's been vetted by the Department of Housing and Urban Development. It's on their list. And there's also an inspector that's associated with the Department of Housing and Urban Development. And so they would be doing a bid as well, and that's compared to the bid that you get from the general contractor to make sure that things are in line cost-wise. And we always suggest, let's go out and get a minimum of 2 bids, but preferably 3 bids, so that we can see how all the numbers are coming in and all that. And then once we have the general contractor bid, there's paperwork that has to be done by the contractor for the loan, underwriting of the loan. So there's a whole package that we send out to the contractor that they have to complete and provide this information. And that's sometimes that's a little bit difficult for contractors and paperwork to work together. But, but we guide them through that, and we try to tackle that as soon as possible in the loan process.
Yeah, and I think it's important to find somebody who's done this before as far as a contractor, not somebody who just got their license, or somebody who's not worked with HUD before, but somebody who's had a little bit of experience to work on that, because I think there's a learning curve on their end, on the bureaucracy side of things.
Exactly. But once you get through it, and they follow our guidance and they follow just the checklist that we lay out for them, then we're off and running. So it's not as scary as it sounds, but it's just a bit of a paperwork issue that we have to take care of.
Right. And so the paperwork on the work, it's not dealt with the borrower at all. It's only between the lender, HUD, and the contractor.
Correct. Yeah, the borrower doesn't get involved in that unless there's decisions that need to be made, on materials or those types of things.
Red, blue, white, pick a color. Okay.
Exactly. Do we want the quartz countertops, or do we want the concrete countertops?
Yeah.
But the paper, we have a special department. We have our own renovation department inside Movement Mortgage. That's all they do.
Nice.
It's just these loans. It's not processed or underwritten by our general processors and underwriters.
Okay.
It's a specific department that it goes to. They live and breathe this stuff all day long. We have a team lead that jumps in and helps out right away with working with the contractors. So they try to streamline that process.
That's good. That's good to hear, because I think the whole process and knowing how it all works, I think that kind of puts more ease to a borrower or buyer who might be thinking of this right now and is thinking, oh, I could get a nice house to do through this process, at least take away that pain that everyone thinks about. Because I talked to a buyer the other day and just, well, do I go through that whole pain process to go through the loan, through the process, and try to get through this, and it doesn't make sense, is it worth it? I think that's what they're all asking.
Yeah. Well, I think when they see the equity position that they're going to have after it's all said and done, then it definitely makes it worth it, because everybody's looking for value in this market, right?
Right.
Because we've seen, a record number of years of appreciation all across the board in every single market here in Southern California and Western U.S. And so everybody's on this hunt for value. So if they can find that property that is perfect for them, maybe location-wise, and has the general layout that they prefer, and they can get it for 20% under market value, 15% under market value. It's definitely worth it.
Absolutely.
Yeah.
Absolutely. And I think we're going to have a period of time where, the population is aging in Southern California specifically, and whoever's listening out there, whatever your area is, try to find that out. But I think there's going to be these outdated homes that will be available, and so you might want to be ready for that case. So,
Exactly.
Working with a direct lender like yourself that has that process streamlined, completely, which you and your team and your company have done consistently. Well, make it easy for the buyer to buy the house. Now you have this other process where everybody else may not have that easy streaming process, and you said you have a dedicated part, which is awesome. So that's phenomenal on there. Okay, so based on that, and then paying the contractors, you said that the department, how it works is that they're giving. How does that work as far as paying them out with the contractor?
Yeah, so with FHA, if we're doing and I'll just go through the different programs here. So
yeah, sure.
With FHA, we have our standard, 203K standard. The designation with FHA is called a 203K. That's just the internal HUD designation to earmark it as a renovation loan. And so the standard one means if the renovation costs are more than $35,000, then we go on our standard 203K program. Right? And so what they do is they distribute money to the contractor on a draw basis. They get up to 5 draws during the construction period or the renovation period. And so once the renovation budget is finalized and we close the loan, the money used for the renovation is held back in escrow, and then the contractor does their work. And as they complete a section, the inspector comes out, inspects the work, signs off on it, and then they submit for payment. And then our escrow department, our team back there that's holding the fund, they will distribute those funds for that section and that work that's done. And so they have up to 5 draws that they can take. So it's kind of like a construction loan in that regards. So if we go with our limited, 203K limited program, that's for renovation costs that are $35,000 or less. And so it's a streamlined process. So up to 50% material costs can be taken out at closing, basically initial draw to buy materials and start work, and then they can have up to 2 draws on the rest of the funds to close out the work.
Okay.
And
so a streamline, sorry to cut you off, but the streamline would be, hey, there's a kitchen that needs to be outdated and done, but everything else is okay. So this would be a perfect scenario, right?
Exactly.
Okay. And then the draw part is going to be, okay, so you don't need a HUD inspector, I think.
Correct. You still need a general licensed general contractor, to do the work, but we don't have to have a HUD inspector come out and inspect all the work.
Nice. Okay. And then the conventional, how does that work again as far as the internal workings?
Yeah, so the internal workings, we still go through, we have a licensed general contractor prepare the bid and manage the project. At closing, they can take up to 50% material draw, 50% of the renovations cost up front right after closing to start work and buy materials and do all that. And then they can take up to 5 draws later till the work is done.
Okay. That's awesome. Awesome. Okay.
One of the things I wanted to point out too is, how do I know if I want to go 2 or 3K or do I want to go conventional? And then it just really comes down to your profile as a borrower, based on your credit and income and debt to income ratios. But also it comes down to the work that you want to have done, because FHA doesn't allow for what they call luxury items to be included in the renovation
that's my next
budget.
question. So what is a luxury item?
So a luxury item is like a pool or a hardscaped patio with an outdoor fireplace, those types of things, or built-in barbecue. Those are what they deem as luxury items. FHA only allows for basically structural items and an interior product. But you could, with an FHA 2 or 3K, you could basically, as long as you have the foundation and like one wall left standing, you can tear it down and redo the house completely. I mean, and you can add a story on it. You can, there's a myriad of things that you can do on these things. So, there's a lot of flexibility with it.
That's good.
But just that's one distinction that you need to make is, if I'm that buyer that I want that epic outdoor California room in the back with the fireplace and the barbecue pit, well then we're going to look at home style.
So not luxury features, not extra RV space, not pool with infinity features, solar, probably none, and probably other things kind of similar, just that are, I guess, like I said, on the outside. So but on the inside, it's you can kind of do what you want, I guess.
Right.
Okay. Now, I do notice also that some of these renovations can be done for multifamily homes, so 2 to 4 units.
Exactly. So you can do that under FHA or home style. VA can only be 1 unit. Has to be owner occupied in 1 unit. FHA has to be owner occupied.
Okay.
But it can be multi-unit up to 4 units. So as long as the buyer, you're going to be occupying one of the units, then you can buy that property and you can go in and renovate those units and to increase rents.
Yep.
You can renovate those units to increase value, and it's a great way to acquire a multi-unit property and live in one of the units, and then you go through that. And then home style for investors, it's a great way to go in and buy a property and renovate the property if you don't have the cash to do that.
Right.
And you don't want to get into these, fix and flip loans that are at the higher rates, because these loans are at market rates. They're at the conventional market rates. So you can go in, set up a budget, fix up the units, so that way you can generate higher rents for that property.
Okay. Is it possible to add another unit?
Possible to add another unit
Yeah,
as
go
far
from
as
maybe
go from
2
a 3
units.
unit to a 4 unit?
Yeah, 2 to 3, 3 to 4.
I don't believe it's possible. It has to go. You're going with the existing unit
Okay.
that's there. So.
Okay, that's good to know, because that's probably another question that's out there.
Yeah.
Okay, so that would be good, and based on that, with the multifamily side, are they looking as far as for appraisability for after market rents, or I'm sorry, after rehab value, like rent would be, or is it value? How do they determine?
So when we have the appraisal that's done, they're going to give a value to the property based on the renovations that are proposed, that are on the plans. And so they'll give it a future value as far as what the market value is. And then they're going to do a rent survey as well.
Okay.
So the appraiser's going to give an opinion of rents, market rent that's available as part of the appraisal report. So
Nice.
It's going to be a rent survey.
Okay.
Yeah.
So that's good to know, because then you'll get a good understanding as far as with how it all works together.
Yeah, I mean, we have a client that's buying a 4-unit property up in Long Beach right now, and this has been in the family. This property's been in the family for a long time. Not his family, but the seller's family. And so they've had tenants in there for a long time, right? And the rents that they're charging are well below market, but they're going to come in, they're going to fix it up a little bit, and then they'll be able to increase rents dramatically just because of the fact that they can do that and have a nicer unit.
Yeah, and I understand that, because we're selling our multifamily as well. So
yes.
So yeah, that's exactly it. You want to kind of add some value to raise those rents. You can't just raise rents for nothing. You're going to piss off the tenants.
You'll have a few issues. So.
Yeah, that too. So you want to the idea when you're investing in real estate is to build value, not just buying just to make money, or else you're gonna lose everything.
That's one of the things that we like to, part of our business that we do is to advise clients is, we want families to generate wealth, to build wealth by making smart mortgage decisions.
Absolutely.
And knowing, not many people really know these products even exist. And so, we sit down with clients and we go over, hey, this is an option for you. Oh, wow. Well, then it opens up the ideas, it opens up the opportunities, and, if you can help a client build wealth and show them how to do that, and that not only affects them right now, but it affects their family down the road and future generations, because they're building wealth in their portfolio.
That's good. So that's good, and I think you and I both talked about this all the time, that when inflation does come in, I think when you're locking these low mortgage rates, because they still are low in my opinion
historically,
and inflation, what it does is any fixed rate, fixed debt, it eats it away. So if we do hit inflation in the future, that this will eat up your debt away pretty quickly.
Yeah.
But all those renters out there, inflation hurts you.
Yeah.
So it's going to keep you away. So I think that's kind of important with getting into a house to buying it right now. So Dave, what's a good way for a borrower to reach out to you?
So a number of different ways. Obviously, you can give us a call directly. It's 949-449-2477.
Okay.
That's a direct line to the office, and then it's forwarded out to us. You can go on our website, marzinkelendingteam.com.
I'll attach that to the notes, so that'll be a quick click on there. And what states are you licensed in?
So myself, I'm licensed in Nevada, California, Texas, Florida, and Arizona.
Okay.
And then my partner, Leslie O'Neill, she's licensed in Louisiana, Florida, as well as California, and Texas as well. So.
It's good.
Yeah.
That's good. Okay. That's good to know, and I think if you're ever listening and you live in those states, reach out to Dave and call Leslie, and they'll definitely help you out on that. And your process to getting a loan is one of the easiest that I've seen, and not only is it easy to get processed, is that you guys deliver. I think that's important because I hear, oh, it's easy, but I don't see the delivery with anybody else right now. So you guys have the top delivery to get it done, and it's really important for us as the realtors, whether we're on the selling side or the buying side, to see your guys' delivery on there, because we know it'll happen.
Well, we've got an operations team that in Tempe, Arizona, that is the best operations team I've worked with in business, bar none. Mm-hmm. And the leadership over there with Kay Hamilton, who leads the whole entire group, the entire operations center over there, to Dallas Skinner, who's our processing team lead, to our underwriting managers. I mean, everybody on down. It's just it's phenomenal work ethic, and they support us in a major way.
It's good. Okay. So who does Michigan play this week?
Notre Dame.
Oh, that's gonna be a fun game on the Notre Dame broadcasting channel, NBC. So
NBC. So we had a heartbreak of a loss against Penn State, because unfortunately dropped the ball in the end zone, and they would have tied it up. But you guys got close with Army too. That was a close game, but Army's good. Army's good. So.
And obviously, I don't want to talk about your Denver Broncos.
No, they're trading away everybody now.
Yeah, they're trading everybody away. You guys,
you're welcome, San Francisco. You got a great receiver. So.
You guys are looking for the future at this time.
Yeah,
so
we're gonna tank for Tua. So.
So, okay, Dave. Anything else about renovations that we've covered, or anything you want to add in?
No, I just obviously it's a great loan product. Not many companies have the operations to do this. There are some really good ones out there that do this, but you have to. It's a great product to explore, and if it fits what you're trying to accomplish as a buyer, then sit down and explore that option, and don't be afraid of it, because if you have as long as you have the information and you have the education, then you can make a good decision. And if you're a real estate agent that's in this market, any market, and you want more opportunities, more at-bats to increase business, then sit down with us and talk about the renovation program, because it opens up a pool of buyers where, these homes that have original owners that are selling the property, they don't just have to go to the investors, the cash buyers. They can go to a new young family that will come in and revitalize that neighborhood and really, give it long-lasting value.
That's a win-win for everybody. Win for not only the seller, but also the surrounding area, because that will raise the comps for everybody. It's a win for the buyer because it gives them an opportunity to live in something and build some equity right away.
Yeah.
And obviously, the schools will be happy because they're retaining the tax rates. Everybody else, it's a win-win-win-win. So thanks for joining in on the Millennial Realtor Podcast, Dave. And obviously, I'll invite you to further episodes for more lending topics and mortgage updates and all that other fun stuff.
All right, Conrad. Thanks for having us.
All
man.
right. Well, thanks for listening, everybody, and we'll chat soon at the next Millennial Realtor Podcast.